Well, if you're joining us right now, we got some folks who have joined us online. Welcome to our Maximize Your Impact and Add More Tomorrow's event. So we will be starting here a little shortly in about five to 6 minutes. We'll let the folks coming in out of the rain, if you're local here in Nashville, get settled in and log in. And then we'll kick it off with a great cocktail demonstration to warm you up right away if you're chilly from being outside today. Looks like we have some more folks joining us, about a few more people online. Looks like a good crowd so far. Welcome everybody. If you were just joining us, you all are muted. Anybody entering the call is automatically muted and your video is muted, so you don't have to worry about that. We will be starting shortly in just a few more minutes. Give folks some more time to get on. Hope everybody's taking a moment if they're planning on mixing a drink with us to kind of pull those ingredients together that I sent out. If you haven't, happy to repeat the ingredients out loud, or maybe Bobby can also repeat the ingredients out loud. I definitely know you need a rye whiskey, some bitters.
So pretty simple ingredients. We just are going to need, like you said, either a rye whiskey or a bourbon, some bitters, maple syrup. I would recommend a high quality one, more so than your just run the mill Aunt Jemima stuff. And then ideally a fresh orange, and optionally kind of a Luxardo cherry or a cocktail cherry of some sort. But even if you don't have all of those, you can kind of make it work pretty easily.
Yeah, and after we do the presentation, I'm sure if you didn't make it tonight, we'll send the recipe out, or I'll send the recipe out and you'll get to make it at another time. So even if you're just pouring a glass of wine with us this evening, we will have the recipe going out. All right, once again, welcome. If you're just now joining us, you are on, all of our attendees are on mute and are unable to speak or be seen. But we are going to start here in just a few minutes. Thank you so much for being with us this evening to learn about how you can maximize your impact and add more tomorrows. We'll be starting here. Let's give 2 or 3 more minutes for some latecomers to join up, and then we'll kick it off with our drink presentation. I think we'll go ahead and kind of kick this thing off. Looks like we've got a good amount of people here. And as people will join up, I'm sure they'll learn. Welcome everybody. My name is Dustin Tracy. I'm the Associate Executive Director here in the Nashville chapter of the Cystic Fibrosis Foundation. Really appreciate everybody taking the time to come out tonight and learn a little bit about a new twist on a classic cocktail, and then sit down and learn a little bit more about how to maximize your impact and add more tomorrows with some insights to strategic charitable giving. So we'll the function of tonight, we will go right into Bobby Wegusen's presentation, learn about how to make a classic cocktail tonight. Then I'll introduce Brian, and we'll chat a little bit about the financial side, and then we can use some extra time afterwards to answer any questions you may have about the presentation. I ask, if you do have questions, that you feel free to utilize the Q&A part of Zoom, which is at the bottom of your screen. You should be able to click in and type in a question. We'll be monitoring those. And then the chat function, if you just want to shout out or say thank you or recognize other people on the call, that's a great place for that to happen. So I'm going to go ahead without further ado. I'll introduce to you Bobby Wegusen. He's a liquor industry veteran, over 12 years of experience in various positions. He's the current regional sales manager at Hodling & Co. And a lot of his liquors include Nika Whiskey, No. 3 Gin, Cavalin Whiskey, Lot 40 Whiskey. So this man is a gentleman that knows his whiskey. So tonight's presentation should be pretty great. So without further ado, I'm going to just transfer it right over to you, Bobby, if I can.
Well, thank you, Justin, and thank you everyone for joining. I'm going to quickly walk through one of my favorite fall drinks, which hopefully you can enjoy this evening, and if not, hopefully very soon. I picked to do a maple old fashioned for tonight for a couple reasons. First, no one's ever going to confuse me for a mixologist. Making complicated, fancy cocktails is not exactly my thing, but more importantly than that, it's super tasty while being very easy to make. I'm also a really big whiskey fan, and I feel like this cocktail really does a great job of accentuating a lot of the really wonderful characteristics and flavors that are already in bourbon. So for some of you that might not be familiar, an old fashioned is one of the oldest cocktails out there. In the early 1800s, there was actually a drink just called a cocktail. It truly was the original cocktail. And it was defined as a mix of spirits, sugar, water, and bitters. Over the years, what we define as a cocktail has obviously changed, so the name had to adjust, but the original drink was renamed the Old Fashioned. Typically speaking, an Old Fashioned is made with bourbon or rye whiskey, sugar, potentially some water, and bitters. But like I said, tonight we're going to substitute some maple syrup in for the sugar, or utilize that as our sugar base. Bourbon has quite a bit of natural sweetness, so you don't need to overload it with anything. But again, that maple syrup just brings out some of those caramel flavors, the vanilla flavors, some of the sweetness, and then it's balanced out with the bitters and the dilution. So with that said, super simple to make, and we can kind of get started. For those that weren't already with us, the ingredients on this are going to be the whiskey, so either bourbon or rye traditionally, bitters, maple syrup, an orange, and then if you want a maraschino cherry to add onto the side. So with that said, we'll get started. The first step is, I've already peeled it or gotten some orange peel, but you'll just kind of peel off with either a knife or a vegetable peeler a slice of orange. You'll want to rub the rim of your glass with that, kind of get the oils and flavor kind of on the rim, and then you'll squeeze it, and hopefully you have just enough pulp and zest to get into the bottom of the cup, start getting that acid. Now, next we're going to be adding the bourbon and the bitters and maple syrup. And while for this cocktail it's pretty simple, kind of an insider thing, when you're making a drink, typically you're going to be wanting to start with your cheapest ingredients. That way, if you were to screw it up, you're not wasting the good stuff. Again, with this cocktail, pretty easy. So we're going to start with 1/2 ounce of maple syrup. I highly suggest using a high quality maple syrup. The one I'm using was actually aged in some bourbon barrels. So you definitely want to avoid like anything with sugar free, because then you're not going to get the characteristics you're wanting out of this. And so 1/2 ounce. Now, if mine isn't too thick of a maple syrup, if it is a little thicker, you might want to use this time to dilute it with a little bit of water to just help. And then we're looking at 2 ounces of bourbon. You're going to want to do this in a glass that you don't have the ice in just yet. 2 ounces. At this point, it should have this kind of oily looking texture to it. If it doesn't, you probably want to add a little bit of water and a little bit more maple syrup. And then from there, just a couple dashes of bitters, which if you haven't used bitters before, these are, they're almost like salt to a bartender. They're something that it's hard to define exactly the flavor they're adding, but at the same time, a cocktail that doesn't have them, you would notice they're missing. So from there, you'll want to just stir that up a little bit. Get those ingredients mixed. And then at this point, this is when you'll want to add the ice. And from here, a big key to this, because at this point, the cocktail is pretty much all whiskey. You have a little bit of the maple syrup and a little bit of bitters, but it's all whiskey. So the dilution is going to be very important. So you're looking at about 20 seconds of stirring, 20 to 30 seconds to really get it mixed and a combined cocktail. A little bit more to go from there. And at that point, you're pretty much completed. I tend to like to add a Luxardo maraschino cherry, really complete the drink. If you haven't had them before, they're a little bit of a splurge, but they are amazing. They're a great cocktail cherry, and they're a great addition to the cocktail. But otherwise, that's about it. So cheers. Hopefully everybody is able to enjoy and have a great night.
Thank you so much, Bobby, for that awesome presentation. Really appreciate you doing that for us.
Yeah, of course.
All right. Now I'm going to introduce our next speaker, kind of the main event. So now that we've got our drinks and our warm-ups, I'd like to introduce Brian Reichenbach. He is the financial expert this evening. Brian's the co-founder and Chief Operations Officer at Chronicle Partners in Brentwood. He's a certified financial planner with degrees from Miami University in Ohio and Vanderbilt Law School, and holds a lot of industry designations. So we're so excited that he's here tonight with us, and I'm gonna go ahead without any more, gonna get him going. So let me, Brian, if you wanna turn on, there we go. All right, and I'm gonna spotlight you. And then you'll have to unmute as well.
All right, can you all hear me okay now?
Yes, we can.
Perfect. There we go. Okay, great. Well, thank you, Dustin. Thank you, Bobby. This is exciting. This is the first time I've ever been the main event for anything. So for the rest, I voted for Bobby having more time, but we'll focus on taxes today. So yeah, I'm gonna just kind of move through some kind of, I think, generally asked questions that most folks have, and try to move through this fairly quickly to give ample time for some questions at the end, and I can drill into any of these topics in some more detail. But yeah, we're going to talk about how to best utilize your assets for charitable giving. So like Dustin said, we can add more tomorrows. We can either keep more of our own personal assets or give more to charity. You know, really the only one losing out here is the IRS, and most people tend not to shed too many tears over that. So I'll start off, and really we're going to focus on the different types of taxes that you can potentially avoid or receive some benefit from when you're gifting. You'll see here there are three main ones, or three direct potential taxes that we can receive some benefit from. And the first, estate gift tax, capital gains tax, and then income tax. So we'll start with estate and gift tax because frankly, it's it's the easiest to talk about because it affects so few people today. And I'll start with, I said estate/gift tax. I think one of the common misunderstandings of the tax code is that those are two different things, and actually they're the same thing. So every individual person today in the year 2020, if they pass away, they can leave up to $11.58 million estate tax free to anyone else that they want to. You can see that's, if it's a married couple, that's doubled. That number is extremely high. Historically, that is the highest it's ever been. I say it's likely to be reduced in the future, and that's the last. This gets into politics, and we've all had enough of that recently. But there's a good chance that we'll see some changes to the tax code, and we will. I won't say there's a good chance. We'll see changes to the tax code because we always do. But historically, this number is really, really high. So the federal estate tax just affects very few people today. But I say it's estate/gift tax because technically, if you have $11.5 million to give away today, you can do that before you pass away. And gifting that to someone else, there's no tax implication. But if you were to give away $12 million today, basically that excess of $420,000, that would be taxed by the giver, or I'm sorry, to the giver. And that it's a hefty tax today at 40%. So as that exemption comes back down, this is an important consideration for folks later on in life. But again, today it affects very, very few people. And I put the annual giving exemption down there as well. So every year, any person can give up to $15,000 to anyone else without tax implication and without reducing that lifetime exemption of the $11.5 million. But importantly, for our purposes today, that does not affect gifts to nonprofits. You can give as much to a nonprofit as you want to, any time while you're alive or when you pass away, and that does not affect your $11.5 million. So for a lot of folks later on in life with large estates, charitable giving is one of the really important strategies to get money out of their estate so they get below that exemption amount. And then the estate or the money left over isn't going to be subject to that 40% tax. Okay, capital gains tax. So this is one potentially really good opportunity for a lot of folks that give charitably, because most people that give charitably give cash. They just give out of pocket, which isn't bad, but this is potentially an easy way to, again, give more away or keep more money in your pocket. So capital gains taxes, well, there are two types of capital gains tax. So short-term capital gain and long-term capital gain. So short-term, you pay a short-term capital gain when you sell an investment that you've held for less than a year. As soon as you've held that investment, and that can be real estate, it can be stock, it could be a mutual fund, it can be a lot of different things. But as soon as you've owned it for more than 12 months, it becomes a long-term capital gain, or the earnings portion becomes a long-term unrealized gain. When you sell the property, that's when you realize the gain. So if I stick to it here, so you'll see on the left, short-term property held less than 12 months. Don't give short-term property to charity. It is not, you don't want to give away short-term capital gain property to charity because you can only deduct the basis. You don't deduct the earnings. So you never want to give property that you've owned for less than 12 months. It's better to sell it and then give the proceeds. I can explain that more. Long-term property, long-term capital gain property. If you own that stock for 12 months and a day, and let's say that you picked a great stock and it's doubled in value, this is a very good gifting opportunity for charitable purposes. If you gift that stock to charity before you sell it, if you sell it, you're going to realize all of that gain yourself. But if you gift it, you're going to avoid all of that gain. And the 501c3 that you're gifting to, the public charity, they're not going to pay taxes on it either. So just any long-term property gain, capital gain property is a very good candidate for charitable giving. And again, you say I put in there the most popular is publicly traded stock, or funds, mutual funds, ETF, index funds. Those are very simple to give. I'll talk a little bit more about real estate and closely held business interests, and those can be really great opportunities. They're just more complex. The last bullet there you'll see on the right of gifts to a 501c3. You never want to gift any property that is at a loss position. It's always better to sell it, realize the loss, because you're going to get a tax benefit personally for that loss, and then you can always gift the proceeds. But if you gift before you realize the loss, you're not going to receive that tax benefit of the loss on your taxes. So it's always better to sell property at a loss and take the loss personally before you gift the proceeds. So capital gains rates, put this on here just so folks could see it. I think there's a lot of confusion around capital gains as well, and I'll talk about how this fits in with income taxes as well, which is a little confusing. Basically, capital gains are stacked on top of your income. But you can see the first two columns there, single filers and married filing jointly. Those are what most folks do. And basically the first $40,000 or $80,000 of capital gains that you realize, if you didn't have any other income, you'd pay a 0% rate on. After that, the 15% bracket is pretty significant. And then the 20% bracket kicks in at really high dollar amounts. There's another Medicare surcharge tax in there at 3.8%, which we've left out. But anyway, that's what capital gains rates are. So again, if you're going to fall in the 15% range or the 20% range, again, instead of selling the property and then gifting the proceeds, you can immediately receive a 15 or 20% tax benefit by gifting those proceeds to a charitable entity. So income taxes. So income taxes are the last potential tax that you can avoid when you are gifting charitably, and it's the most complex. So I'll spend a little bit of time focused on this. So when you file your income taxes, I'm going to start with basics, and I apologize if I'm talking down to anybody, but when you file your income taxes, you're always going to take either a standard or an itemized deduction. If you take a standard deduction, you are not going to receive any tax benefit for income tax benefit for your charitable giving. If you file itemized, you can receive a tax benefit for charitable gifts. So really, I say it's one or the other there. You're always going to take one or the other. Either you're going to file with a standard deduction or file with your itemized deductions. And you're only ever going to file with an itemized deduction if your total itemized deductions are more than your standard deduction. So in 2020, a single filer, and really it's every individual person has a standard deduction of $12,400. So you can see a single filer, it's $12,400, and then for a married couple, it's just double that. Put head of household on there too, but very few people actually file head of household. And then you can see there are some additional standard deductions to be added on if you're 65 or older and or blind, which is a weird idiosyncrasy of the tax code. But basically, if you're a married couple and you filed jointly, you have to have more than $24,800 worth of itemized deductions to get any tax benefit, income tax benefit from a charitable gift. We've also got the income tax brackets to the left there. Again, single and then married filing jointly is what you'll see most common. Most people know this. Well, I shouldn't say most people know this. I think a lot of people actually don't totally understand this, but the income tax brackets work in what's called a graduated tax bracket system. So if you're filing single, the first $9,875 that you earn, you're paying 10% of taxes on. The next $30,000, you're paying 12% on. So on the next $45,000, you're paying 22%. So it's not that you go $1 over that $9,875 at $9,876, you pay 12% on everything. You just pay 12% on that dollar over the $9,875. So as folks get into higher and higher tax brackets, they tend to want to look for ways to reduce their taxable income and knock out of those high tax brackets. And charitable giving is one of the great ways to do that. Okay, itemized deductions. So again, it's either $12,400 or $24,800 if you're not age 65 and or blind, but you have to have that level of itemized deductions or greater than that level of itemized deductions to receive a tax benefit. So the major itemized deductions that folks will receive are interest that they're paying on their mortgage. So you'll see it called SALT, state and local taxes, which has a limit of $10,000. And in Tennessee, we know we aren't paying an income tax in the state of Tennessee. So most folks don't have a lot of, they're not going to get to that $10,000 level, but most folks can use their property taxes if they own a home. Medical expenses, you don't see this one too often, but if you have significant medical expenses in a year, those can be an itemized deduction. And then also, again, charitable contributions. So there are limitations for how much you can deduct, and depending on what type of asset you're given. So let's say that you earn $100,000 of income, you can give up to $60,000 and fully deduct that $60,000 in that example. Because if you've given $60,000 worth of cash, you can deduct that full 60%. You have a 60% limit of your income that you can deduct in that year. If you're gifting stock or a business interest or real estate or something else, you could only deduct $30,000 if you earned $100,000. So you're limited to 30% of a deduction if you're gifting a long-term capital gain property. And all of this is for qualified 501c3 organizations. And this is, you'll hear it called public charities. Obviously, Cystic Fibrosis Foundation is one. Most charitable organizations are qualified 501c3s, but you want to make sure of this when you're giving, because if it isn't, you might not be able to get that tax deduction for the gift. I also put on there, watch out for AMT or alternative minimum tax. Anyone that's spent any time dealing with the tax code knows that that's a scary term. And I won't spend too much time on it. I will just pause here and say, again, this is high level, broad. There's a lot of nuance to the tax code. So you want to spend some time personally and make sure that what you're doing does actually fit yourself, because there can be a lot of differences from person to person. The alternative minimum tax is basically, it was the government's effort of making sure that high income earners don't receive too much deduction from these itemized deductions. So there can be a limit where if folks receive too much of a tax benefit from itemized deductions, they'll instead have to pay the AMT, the alternative minimum tax, and it is confusing. All right, charitable bunching. So this is one real strategy to consider for a lot of people, especially as you're coming up on year end. This is a good thing to consider. That's a little bit outside the box, but can be a really good way to maximize the tax impact of your charitable gifts. So really the idea of charitable bunching, and I'm going to walk through an example with some numbers here in just a minute, but the idea of charitable bunching is basically we want to bunch, or we want to lump as many or more of our itemized deductions, primarily charitable gifts, in one year if possible. And then in a subsequent year or years, we won't have as many itemized deductions because we try to lump them all together in one year. And in that subsequent year or years, we're going to take a standard deduction. So this is especially beneficial for folks that are nearing the standard deduction limit, either right above or right below. If we can get well above the standard deduction limit in one year and take a larger tax deduction, we can basically maximize your deductions and basically save more tax dollars. The limitation of this strategy is cash flow, because again, in order to receive more itemized deductions, the main lever to pull, and the main thing we're talking about is making charitable gifts. So we're talking about basically giving more in 1 year, either directly to a charity or to a donor advised fund or some other charitable tool. I'll get to that in a second. But you're getting money out of your personal account where you can use that for, you know, your air conditioner failing or your car breaking down. So you're taking money out of your cash flow and setting it aside where it needs to be used for charitable gifts in the future. Again, if they're gifts that you know that you want to make, this is a good way to receive more of an income tax benefit. And again, too, I said there, if a taxpayer has a high income year, this is a really good thing to consider. If you have a high income year, you could basically give more, reduce when you're in those higher income tax brackets, knock down out of those higher income tax brackets, receive more of a tax benefit there, and then I'll get to the donor advised fund, but basically keep your giving the same or increase your giving, however you want to look at it. So here's a real live example for charitable bunching. So in this example, I'm assuming that you only have itemized deductions of charitable gifts. Almost everyone has some other itemized deduction, like I said, whether it's property taxes or interest on their mortgage. Almost everyone has some sort of other itemized deduction, but just to keep our math simple, I said the only itemized deduction is the charitable giving. So this is an example of a married couple earning $300,000 a year and giving $20,000 to charity. So in that top example, we're not bunching. We're not using the charitable bunching strategy. And in year one and in year two, we're giving $20,000. And you can see to the right there, we've earned $300,000. We've gifted $20,000, but we're not over that $24,800 standard deduction limit. So we're going to take a standard deduction. So I didn't explain this earlier. I should have. The standard deduction, you're just knocking down your taxable income. So just like itemized deductions. So we are reducing our AGI of $300,000 down to $275,200. And in those 2 years, we have total deductions of $49,600. That's just the standard deduction. There's slight more complication. The standard deduction will go up next year if the tax code doesn't change, but let's say the standard deduction is the same for both years. So total deductions of $49,600. In that example, if we give $20,000 out of pocket each year, total deductions of $49,600. So the second example down there is using the bunching strategy. So in year one, we give $40,000, and I said $40,000 to DAF, which is donor advised fund. It can be straight to charity, but we're giving $40,000 to a charitable, to a 501c3 organization. Basically, we're gifting for tax purposes. So we've gifted $40,000. So now we have itemized deductions of $40,000 in that first year. So now we knock our AGI down to $260,000, and in the second year, we're not giving anything out of pocket. We're not using our cash flow for charitable giving because we've given our $20,000 for both years in the prior year. So in the second year, we're going to take the standard deduction of $24,800. So in those 2 years, you can see the bullets at the bottom here. The charitable bunching generates an additional $15,200 worth of deductions. And if you're at the 24% tax bracket, which I think we are in this case, we're saving $3,600 plus in real dollars. So this is just one example. You can guess this can play out in a lot of different ways depending on what your income is. Again, if in year one you're earning $500,000 and in year two you're earning $100,000, then that bunching is even more attractive because you're knocking down out of even higher tax brackets in that first year. So there are a lot of different ways to strategize here. You also don't just have to give over 2 years. You know, if you were to lump 3 years or 4 years or 5 years of gifts all in year one, the benefit continues to get larger and larger as well. So this is a a good thing for folks to consider, especially if you give very very regularly, and also if you have high income years. Okay, so this is another good, easy strategy that any of the right people can use. So you'll see qualified charitable distribution. You'll see it abbreviated as QCD, or you'll also hear it as charitable rollover, charitable IRA rollover. So the idea here is, instead of giving out of pocket, you're going to give directly out of your IRA. So we can only do this once we have hit age 70 and a half. So some of you may know, once it used to be age 70 and a half, the government pushed it back to age 72 now, but at age 72, you're now required to take distributions from pre-tax retirement accounts, whether it's a 401k or an IRA, and there are a bunch of accounts, but any pre-tax retirement account, you're required to take distributions at 72. It used to be 70 and a half, and they didn't change this part of it, so you can still do the QCD at 70 and a half for some reason. But basically, you can give up to $100,000 from your pre-tax IRA directly to a public charity any given year, and no one pays taxes on that money. So the beautiful thing here is, when you're contributing to your 401ks or a traditional IRA, you're getting an income tax benefit. You're getting an income tax deduction for that contribution. So either when you put money in or your employer puts money in, someone's getting an income tax benefit, or at least no one is paying income taxes as the money goes into the account. And as that money grows tax-free year over year, again, you're not paying any taxes on the money. So when you get to age 70 and a half, instead of giving cash out of pocket that you have paid taxes on, instead of receiving distributions from your IRA, and especially at age 72, when you're required to take those distributions, if you don't want to pay income taxes on the dollars, you can send it directly to a 501c3. And again, you're not paying taxes on the money, and they're not paying taxes on the money. So it's a really powerful thing for folks. Again, if you're giving out of pocket, a lot of people are giving out of pocket and they're still filing a standard deduction, so they're not receiving any income tax benefit whatsoever. So if instead of giving out of pocket, you give out of your IRA, if you're 70 and older, you're immediately coming out ahead from a tax perspective. So to be clear, you're not getting an income tax deduction. You're just stopping money. You're stopping dollars from being added to your taxable income for the year from those distributions. A couple of little nuances as well. A QCD, or the charitable rollover, has to be made from an IRA. It cannot be made from a 401k. You also you cannot send these payments to a donor advised fund. They have to go to a public charity, to a 501c3. Okay, donor advised funds. So I'm sorry, I know I mentioned this a few times. It's hard to figure out the right order to go in here to talk about things. Donor advised fund, it's becoming more and more of a buzzword and a popular tool out there. I think even a few years ago, nobody knew what they were, but more and more, I think people at least have heard of them. A donor advised fund is a very, very good tool for charitable giving. It again comes with its own nuance and a little bit of complication or downside, but I'll give you the financial planner perspective is the good certainly outweighs the bad, and I'll address a little bit. They can be a little annoying for the charities themselves, and even for givers too. But they're a really great tool. So you can see I called them a simplified version of a charitable trust or a family foundation. So it is a way to set up a charitable account basically by filling out a form. You're not going to see an attorney and filling out, a bunch of documentation and paying thousands of dollars to set up some sort of a trust or anything like that. You're literally filling out a form with a financial institution to open up a donor advised fund. in your name, your family's name. You can name it whatever you want to, but you're opening up an account. It's just a charitable account. So the other point that I think is really important is that it separates the tax impact of the gift for the individual from the charity, from a specific charity's receipt of the funds. So take the charitable bunching example in tandem here. So you've got a high income year, and you want to tithe, or you want to whatever, you just want to make a large gift and want to reduce your tax footprint that year when you've got a bunch of taxable income, and you know a good portion of those funds you want to give away to charity, but you don't want to give all, $50,000 or whatever number you want to add in. You don't want to give it all away in year one. When you make a gift to a donor advised fund, you receive the tax benefit in the year you make the gift. So the money or the investment, I'll get to that, but the funds go into the donor advised fund, and a donor advised fund is a 501c3 organization for tax purposes. So whether you're putting money into a donor advised fund or you're giving directly to a public charity, the tax impact for the individual is the same. But once the money goes into the donor advised fund, the giver now has a level of control over the account. I say a level of control because once the money goes into the donor advised fund, the gift has been made for tax purposes. So you cannot use the money for personal benefit in any way. And there's a little bit of nuance to that. But the money has to be sent out to another public charity, to a 501c organization in the future. It can't come back out and be used for personal use. But once the assets go into the donor advised fund, there's not a required distribution year by year. You can give it all out in day one or year 10 or year 20. They can be more of a legacy piece where it can flow down to the next generation. There's a lot of good to a donor advised fund. You can also do it with smaller dollar amounts. So again, it's not spending thousands of dollars to set up a charitable trust. You can, if you have a stock that's highly appreciated that's worth $10,000 or $20,000, you can gift that into a donor advised fund. So the minimums for a lot of these institutions is $5,000, $10,000, $20,000 to open up a donor advised fund. So again, no annual grants. That's important, but you can give it all out right away. It's also going to be invested. So whether if you're planning on giving it all away in a fairly short period of time, you're probably going to invest it more conservatively. But if the plan is to gift 5% from it a year or something like that, you can have the money invested and let it grow and gift out the growth. And none of the growth is going to be taxable to you because, again, the account is its own charitable entity at that point. Donor advised fund also, I mentioned stock. A donor advised fund allows you to get into some pretty complex gifts too. If you have more substantial assets, you own a small business, or you have a partial interest of a business, or real estate and some of those things. If you get into big dollar amounts, and you don't want everything to necessarily go to one place, you can fund a donor advised fund and then give out of it year by year. And again, if you're following along, giving the stock, giving the real estate, giving the business interest, you can avoid a lot of capital gains. You'll see this a lot with business owners that started a business decades ago, and when they sell it, they're going to pay, if they've grown it to a good size, they're going to pay 20% on everything. If they gift 10% or whatever to a donor advised fund before the sale, they can avoid capital gains tax on whatever portion they're gifting, and they're going to get the income tax benefit of that gift as well. And it gets it out of your estate. So you can get into situations where you're going to receive a tax benefit on all three fronts when you get into some of these things. I know that was quick, and I probably moved over some things too quickly. So I hope some of you do have some questions, and I can talk about some of that in some more detail. But thanks for listening to me so far. I know that might have been a lot.
No, thank you so much, Brian. Yeah.
Yeah, go ahead.
Obviously, some really great information there. We'll give folks some time to kind of do this for a minute as they come up with some questions. But in the meantime, I did have some questions that I thought I might go touch base with you on. I guess, and this might be a broad question, but at what point is it more advantageous for individuals if they were to create their own 501c3 and then give directly through that to charities? Like, we've had organizations give to us, consider that, and sometimes they backed off of it. But when does that become a good move for somebody?
Just to make sure I understand you correctly there, Dustin. So are you saying of establishing the donor advised fund? At what level does that make sense for folks?
Oh no, like establishing your own 501c3.
Oh, establishing your own.
Yeah.
Yeah. So there are a couple of different ways to do that. So really, even establishing a donor advised fund is technically establishing your own 501c3 because it is technically you're becoming part of a larger 501c3 that the donor advised fund is sponsoring. But if you're going to, so I think maybe you're asking it like a supporting organization kind of tied to a specific 501c3 or even just creating your own entity. So, or even maybe a public foundation too, or I'm sorry, a private foundation, a family foundation, which has its own complication as well. So if the question is around like a private foundation, the rules around private foundations, I didn't touch on those intentionally because they're really complicated. If you've got a family foundation, the tax rules and the income tax limits that I was talking about are entirely different. What you can gift is actually entirely different. You don't want to gift real estate. You don't want to gift business interests. But if for folks that get into, it really doesn't make sense to get into like a private family foundation until you're talking about, I was going to say hundreds of thousands of dollars, but I'm probably even lowballing it there. It's probably more in the millions range before it makes sense to do a private foundation, just because it's very expensive and it's very time consuming. There can be good reasons to do it, but it's really complicated. Or were you, Dustin, even asking like if I wanted to start my own 501c3 and raise money for an organization similar to the Cystic Fibrosis Foundation, and then gifting the proceeds that I've brought into the Cystic Fibrosis Foundation? Was that your question?
No, you covered it actually. It was more along the lines of major gift donors.
Yeah.
Weighing. We do have another question. So this person wants to know: is the donor advised fund limitless time-wise? Can you make distribution in perpetuity?
Good question. So the short answer is no, but the trail is very long. So donor advised funds have only been around for maybe a decade and a half, maybe 2 decades at the longest. And I do know that by the letter of the law, they cannot exist in perpetuity. But I don't know exactly what the limitation is on that. So I do know that it can pass to the next generation. So when you establish it, you set up what's called successor grantors. So when you establish it, you're actually the grantor. You granted funds to the account, and then you technically you're suggesting grants out to the public charities in the future. But you put down a successor grantor, or you put down a public charity that you would want the money to go to if and when you pass away. So a lot of folks will establish it, and then they'll put their kids down as successor grantors. So the first generation passes away, the kids become successor grantors. I don't know the full answer of the true legacy piece. Does it go to the third and fourth and fifth generation? I know that there's some endpoint where the money would have to be paid out to a public charity, but I don't know exactly what that endpoint is. But it's a long trail.
Awesome, thank you. Kind of shifting over to IRAs. Question here is, giving to a 501c3 directly from your IRA. Notice that you can't gift directly into a DAF. It appears as though you can get the same benefit as you would gifting to a DAF. Correct?
You broke up just a little bit. Could you repeat that for me?
Oh, sure. So the question is about giving to a 501c3 directly from your IRA. I noticed that you can't gift directly into a DAF, but it appears as though you get the same benefit as you would gifting to a DAF. Is that correct?
So if the question is gifting, so just to be clear, I'll speak to gifting out of pocket versus gifting from your IRA. So if you're over 70 and a half and you want to gift from your IRA, I think the question asker was saying you can't send it directly to a donor advised fund, and that's true. You could only send it directly to a public charity. And if you're gifting out of pocket, whether you're gifting to a donor advised fund versus a public charity, the tax benefit is exactly the same. You're not receiving more of a tax benefit by gifting to the donor advised fund, or more by giving directly to the 501c3 public charity. You're basically, again, you're separating with the donor advised fund. You're separating the tax impact from the gift from designating what public charity that money is going to go to, but the tax impact is exactly the same.
Awesome. That looks like that answered that person's question. I do have one more question I'm going to add. You said you can't use DAF for personal use, and that they can be tricky for nonprofits and givers. Can you speak a little more into why that's so complicated with DAFs and receiving benefits?
Yeah, thanks, Dustin. I meant to come back to that, and I forgot to. I was gonna bring myself back to that at some point. I'm glad you asked. So, yeah, I gave the pretty extreme example of giving money to a donor advised fund, and then you can't use it, when your air conditioner breaks down or if your car breaks down or something like that. You get into some more complex stuff with public charities of sponsoring a table or buying an auction item, or some things where you're going to get some personal benefit. And the short answer is you can't receive any personal benefit that's more than just an insignificant benefit. So you can't use donor advised funds to sponsor a table. You can't use donor advised funds to purchase an auction item. You can only make a gift with donor advised funds. So I know a lot of charities run into issues there of, hey, I bid on this, now I want to send $10,000 from my donor advised fund to pay for this, vacation that I just bought, and you have to say, I'm sorry, I can't. You just can't receive a personal benefit from a gift out of the donor advised fund. And most, I think all, you can't split the gift either. You can't say that vacation was worth $5,000, so I'm going to take $5,000 from the donor advised fund and give another $5,000 out of pocket. Anything you give to a donor advised fund, you've got to look at that purely as a gift. You're not going to be able to purchase auction items, sponsor a table, you're not going to be able to receive any benefit from it.
Thank you so much, Brian. Any other questions for Brian? I think your presentation was extremely detailed and covered so much. And for everybody listening, we have recorded this. We will be resending it out. If there's anything that you want to refer back to or share with friends, that recording should be going out tomorrow to everybody who was here this evening, and to some folks who had already notified me that they were not able to attend but wanted to get the content because they were very interested. So I don't have any questions. Thank you so much, Brian, for being here tonight and helping us. I'll put my video back on so they can see me. And thank you, everybody, for attending, and for Bobby for giving us a wonderful drink to go through this with. Well, I think that's it. Appreciate you all being here this evening. Thanks again, Brian.
Thank you, Dustin. Thanks everybody for listening.